What up, Hyperchange? Welcome to another episode. Today we're going to be talking about Bitcoin, and more specifically a podcast that was put out about 2 weeks ago by Anthony Pompliano, aka Pomp on Twitter. He's a big crypto Bitcoin advocate. He has a podcast called Off the Chain, which is a really informative cryptocurrency podcast where he brings on different guests, talks about all kinds of stuff in that realm. But specifically, the episode I'm making today is about a podcast he had called The Ultimate Bitcoin Argument that came out about 2 weeks ago on Halloween, and this caught my, it was actually the first time I've ever listened to Off the Chain. Before that, I just heard about it. I've been following Pomp on Twitter for a while, so a big fan of his sort of thoughts, and found out through the news that this Ultimate Bitcoin episode was randomly taken down by Apple after it had skyrocketed to number 4 on the investing podcast charts, and there was no explanation why. Nobody knew why Apple would take down and censor this podcast, and then after a flood of emails, messages, and tweets from fans, Apple recently reinstated the podcast so people could listen. So of course, the conspiracy theorist in me loved this. It caught my attention, and the podcast had received so many rave reviews that I decided to give it a listen. It's an hour and 40 minutes, and I listened to it twice recently. I actually have 15 pages of notes, single space, that I took from the podcast that we're going to break down in today's episode. None of this is probably exact quotes because I may have typed it out wrong, but I'm going to try and tell you, just summarize and go through all the points they bring up in the podcast. But I want to make it super clear that you should actually listen to the real podcast yourself and don't take my word for it if this is exactly what they said. So the podcast is called The Ultimate Bitcoin Argument, and it involves Pomp, who is the host of the podcast, and he interviews Murad Mahmudov, I hope I'm saying that right, who is a Bitcoin maximalist, so to speak, someone who's been in the cryptocurrency space since 2013, so about 5 years. He's from Azerbaijan, was an international student studying in the US, originally got into Bitcoin when he was doing, I think, a semester in China or something, attended a bunch of meetups, and now he worked briefly in finance and now does Bitcoin full-time. Twitter profile also says he's an angel investor, and honestly, I wish they'd given a little bit more about his background. But frankly, I didn't really care about his background after getting into the podcast, because his arguments and just the discussion at a high level in this podcast just was unbelievable. And the knowledge he has of the entire financial system really blew me away. And as someone who went to school for finance, just this entire podcast is a thesis of looking at Bitcoin as a financial currency and really talking about the cryptocurrency aspect of it, less so the technical software side, really fascinated me. So we're gonna get into some crazy deep stuff. So let's just get right into it. So they start out by saying, what is Bitcoin? Murad says, well, it can be described 100 different ways, but in its most simplest form, Bitcoin is a new form of currency or money, and it's a new way of understanding money. And so what are the most important components of Bitcoin? And he says, well, blockchain is just one of 4 or 5 moving pieces. As much as you like to think that Bitcoin's all about the blockchain, Murad says, although I love Bitcoin's blockchain, I'm less about blockchain overall. It's now just become a marketing term, which I'm sure you guys are all familiar with. One of the other really interesting thing about Bitcoin is the proof of work, time stamping, and security, and how this all comes into play. I mean, we're going to get into all more of this later, but he also says it's not just a currency on a blockchain, it's an interdisciplinary phenomena that covers a bunch of different things at once. And then they get into proof of work, which is at its core one of the most technological breakthroughs of Bitcoin, which solves the double spending problem. And so the double spending problem really simply is, if I give you $1 and you have that paper dollar, then I can't give someone else that same paper dollar. Real simple. But with digital currencies, that can be a huge issue, because the dollar that you're giving is just a digital file. It can be replicated, it can be copied, and this was a problem with digital currency technology built in the late 90s and early 2000s. But proof of work, Bitcoin's technology, allows you to have a secure and decentralized system at scale, time stamping transactions on the ledger, which minimizes the trust needed in a single party. That's the decentralized aspect. And so this allows Bitcoin for the first time to be an alternative monetary system. Now, proof of work, as far as I can, and they don't even really get into this in the podcast, but per my understanding, is this very complex equation that the miners run to authenticate transactions. So I would encourage you all to Google it if you want to learn more. And also, one tidbit here at the podcast, They get into so much and so many crazy theories that you're just gonna have to bear with me and like keep an open mind. There's lots of parts of this they gloss over because frankly, you just can't cover everything about Bitcoin in the amount of time. So just keep that in mind. Just be open-minded about this podcast because I promise we're just getting into the good stuff. Anyway, solving the double spending problem is really what Bitcoin's breakthrough is. This is why Satoshi Nakamoto, who is the anonymous inventor of Bitcoin, was heralded as such a sort of genius because he was the one who combined a bunch of different technologies, several innovations together to create this proof of work solution that solves the double spending problem. And this makes it much more scalable than anything we've had before. Now they go into talking about the governance of Bitcoin. How do you govern this security? Why is it different than other types of money? So the governance of Bitcoin, according to Murad, is not formally defined. He said he'd argue that's a strength, not a weakness of the currency. Technically, the governance has to do with how things get proposed, how things get reviewed, how these things get added in. And he says, unlike you probably think, it's a very, very slow and meticulous process. And a lot of people seem to think that Bitcoin is not evolving. It's moving too slow, at least the code and the technology. But he thinks these people are impatient, and true Bitcoiners are not in this as a 6-year get-rich-quick scheme, but are in this for 80 years, lifetime-esque project. And that's why they want to be extremely careful with the changes they make to the Bitcoin code. He says he compares it to open heart surgery, a moon mission, or changing something at a nuclear reactor. There's a lot at stake. Bitcoin already has 100 billion market cap, and he thinks it's going to tens of trillions someday. I know, sounds crazy, but bear with me. And because it's software, it has some malleability, which makes it very good in a lot of ways, but also in some ways makes it fragile. So that's why it's also so important to be very careful with the changes of Bitcoin, because the fact that it's slow to change is part of what makes, and so difficult to change is also what makes it strong and secure. And that's why he says that altcoins, alternative cryptocurrencies, are so far behind Bitcoin because they're so much more centralized and they're too easy to change. If currencies are all about trust, then you want to have trust in the governance system. And because Bitcoin has such a meticulous system governing it, it has more trust than other cryptocurrencies. And he says VCs think of this as like a software problem. These are software things, and they're trying to apply, tech platform ideology to this when really Bitcoin is a monetary phenomena. And it's really more like a digital monetary metal, the closest metaphor for now. Bitcoin to digital gold, he says, is an understatement. Really, Bitcoin is digital monetary nuclear weapons, or a digital monetary nuclear weapon, because as this gets bigger, there's going to be so much damage that this causes into the world of finance, which we're about to get into. And so he says a lot of altcoin people from the startup venture world have this move fast and break things mentality. He says this is not going to work for a true cryptocurrency. This isn't a dog walking app. This isn't a dating app. This isn't Instagram. It's much bigger than that. They want a huge piece of the financial system to run on Bitcoin, and that's why if this is going to happen, they need to go slower. The interesting point about Bitcoin having software is that if there's something that does work that an altcoin has, then Bitcoin could easily adopt that or take the learnings from that and build it into their framework because it is so malleable. But he believes, and this is why he's a Bitcoin maximalist, so to speak, that once Bitcoin goes to about a several $trillion market cap, all other cryptos will be looked at like penny stocks. Large cap versus penny stocks today will be Bitcoin versus altcoins. Then Pomp says, well, so basically altcoins are lacking security and trading off for innovation. Like they want to move fast to catch up to Bitcoin, and they realize they're not going to win in terms of security. And Murad says, yeah, that's a rational trade-off. It's just really hard to compete against Bitcoin. You can't beat it on security because of the network effect, the amount of miners doing it. It's the biggest network, as far as I can tell a lot of crypto people phrase this as the hash rate. The difficulty to hack the network is harder, and they can't beat it on monetary policy. They have to go other ways to get an advantage, and he thinks this is doomed to fail. Now, this is where it gets really, really fun. Let's talk about the monetary design of Bitcoin, the deflationary nature versus the inflationary nature. Uncensorability is cool. Unseizability is cool. But the monetary policy is the real thing. It's unprintable. Nobody can make more than 21 million Bitcoins. That's the innovation here. That's the monetary policy behind Bitcoin. So if for those who don't know, Bitcoin inherently in its code, only 21 million of them can ever be mined. About 16 or 17 million have already been mined. And over the course of the next 50 years or so, we're going to hit that 21 million number. And so he says, people need to use something as money. Right now, the dollar, the euro, the Swiss franc, etc., people are picking the least worst thing. Let's think about the supply of these currencies. Remember, the supply of Bitcoin is fixed at 21 million. The supply of the US dollar is not fixed. It can be printed at the whim of the central bank. And in the last year, he says that it's increased 6.2%. This year, Bitcoin's inflation is 3%, or a little over 3%. And then on the next halving, it'll go less than 2%, and then slowly diminish until that 21 million number. And he also throws in a tidbit that next Bitcoin halving he thinks will be the catalyst for the next bull run. So makes a note that a bunch of the Bitcoins have been lost, probably about 4 million or several million. So he thinks eventually when it's all said and done, there'll only be about 17 million total Bitcoin that are out in circulation. People have already been pricing in this extreme scarcity of Bitcoin. Even the supply of gold has expanded at an annualized rate of 1.6% over the last 10 years. And by late 2020s, the expansion rate of Bitcoin will be lower than 1%. And so now that we know that there's only a fixed supply of, 21 million Bitcoins, let's get back to talking about the most interesting thing, in my opinion here, which is this concept of a deflationary monetary system versus the inflationary monetary system that we currently live in. We're taught in schools that mild inflation is the best. We're incentivized to have that discourse. There's lots of grants and financing that allocate to certain schools of monetary thought versus other. Basically, he says, these institutions like central banks and the IMF and things like that are sending academic grants to people who support their ideologies, and those people are the people who are at the academic institutions like where I went to school, NYU Stern, that are teaching the students about finance. And there's sort of this inherent bias towards an inflationary monetary system because the research is being funded by the exact people who want that system to be in place. These currencies are local monopolies. They're forced upon us by the top down. Bitcoin is a free market phenomena. He says that it is a wild experiment in Austrian economics that is succeeding wildly in its first 10 years. I would argue this is true. I mean, it's hit a value of over $100 billion in just 10 years as a global currency. It's used by people all around the world. So I would argue that Bitcoin, it's so early in its life, but as an experiment, it's how many other experiments that are 10 years old are affecting this many people that are worth over $100 billion? You tell me. So really interesting to frame it that way. And he says, I believe we will not have freely true markets until currency is something that originates from the free market as well. For thousands of years, gold and silver were the predominant currencies around the world until paper notes became more widespread. You can think of paper as a layer 2 technology on top of metals. And once you had paper notes that were redeemable for metals, the divisibility problem of gold was solved. And then, thus, the need for silver was reduced. And then silver was demonetized further. If you look at the gold-silver price ratio, you'll see that in 1981, gold skyrockets in silver terms after the widespread use of paper money and the divisibility of gold. Very fascinating. He says something similar will happen with Bitcoin and with all financial instruments and assets. When all is said and done, he believes Bitcoin will be the second or third biggest asset class in the world. Maybe only real estate will be bigger. Here's the reasoning. The total supply of all fiat currencies in the world is about 80 trillion if you add them up. That number is artificially diluted and kept small. By continuous dilution, people are disincentivized to store money in currencies. So when you hear inflation, think dilution, because remember, actually, really ironically, the episode I just made about, share structure and knowing how many shares outstanding you own of your company, think about the same thing for money. If there's X amount of value that the US government has or that we have as an economy, but we're constantly printing more and more dollars, like the value's not going up just because we have more dollars, and therefore the dollar in your pocket gets worth less as we print more. And so that's something super important to be considered. You're constantly being diluted and therefore incentivized to keep spending so that, your $100 loses purchasing power every single year very slowly, whether you notice it or not. And so the cost of producing that extra money for central banks is zero. They push a button. Every piece of new paper that gets printed reduces the value of your currency, et cetera, et cetera. Now, for the first time with Bitcoin, nobody can seize your wealth via stealth inflation because of that limited 21 million supply. For the first time in your life, if Bitcoin, becomes this global asset, your ownership of the percentage of the money supply can stay stable throughout your life. You don't have to worry about deflation. People, and what he says is the people in charge don't want us to have a robust store of value because every time they print, they enrich themselves at the expense of everyone else a little bit. And this is why he believes the total amount of wealth stored in currencies is artificially very, very small. People like engineers and surgeons have to play part-time investors in the side or outsource this to Wall Street because you can't hold your money in cash. He says it's like crazy. You need to create this diversified portfolio of stocks, bonds, real estate, FX, just to preserve your wealth. And it's like you have to be a financial expert just to not to get rich, but just to keep the money you've earned and retain that value you've generated for society. And he says there's a famous Jewish biblical proverb where you keep 1/3 of your wealth in land, 1/3 of your wealth in real estate, 1/3 of the wealth in your business. And even as recently as the 50s and 60s, traditional mutual fund and asset allocators had much bigger allocation to cash because there was a lot more trust in cash. But recently, with things like quantitative easing, where we've just printed absurd amount of money to get out of the recession, the trust in these cash systems has been reduced, and therefore people have less faith in cash, and nobody wants to hold cash because if you're due, you're constantly losing purchasing power and being diluted. But now that the genie is out of the bottle, he believes Bitcoin or something like it will reverse this trend where people want to actually hold currency because that currency will not be being diluted. And he says maybe it won't go back to, a third of people holding a third of their wealth in cash, but it'll go back much higher than it is today. And so in this new world and this new thing, Bitcoin, as the money supply, will have no inflation, no borders, no centralized control, making it the biggest currency in the world. So back to that 80 trillion number. If there's the amount of cash we're holding is artificially low because we're being diluted, so we're being forced to put money in other assets, the $80 trillion number is low. If you assume Bitcoin's the global world currency, then it has 80 trillion, but it's too low. So he says that he estimates it to be around 160 trillion addressable market for Bitcoin when factoring in this new allocation where people hold more of currency as a part of their portfolio. Is that this new, Bitcoin, if it wins, or whatever this new cryptocurrency that becomes the global money supply is, will be a winner-take-all market, not a winner-take-most, and he believes that Bitcoin will be it, and it will take 94 to 95% of that fiat market. And I do want to counter this point with my own thought here, which is, the inflationary system, by forcing you not to hold cash, actually forces you to start investing in other things like businesses and real estate. And I would argue that that catalyzes innovation. And so I think people like these Bitcoin maximalists, and in many ways, this is a flaw I used to make myself, we don't give the fiat system enough credit. And that's why I'm explaining this podcast to you. And I love Bitcoin, but I should have disclosed at the beginning, I own a little bit of Bitcoin, actually almost none, 0.01 Bitcoin, which is like $60 worth. I used to own a ton of Bitcoin. I put in like $1,200 of Bitcoin like 2 or 3 years ago, cashed out around like 13,000 and 17,500, ended up making like per Bitcoin, ended up making 20 grand on my $1,200 investment, use that to bootstrap the YouTube channel you're watching. And so I am totally biased. Like I love Bitcoin. I just am fascinated by it's just so interesting to me. But am I convinced that it will do everything they're saying? I don't know, but I just think you got to keep an open mind. And so I own a tiny bit of Bitcoin. That's my history with Bitcoin. But I think they're missing the point of you're forced to invest in all these fascinating different asset classes and forced to invest in businesses in a lot of ways, or pressured by the inflationary model, which I think is good. And I think that spurs technology and innovation, which spurs advances in the human quality of life, which spurs, people living longer, better healthcare, all this sort of stuff. At a very high level is helped by the inflationary model. So if we have a deflationary model where people want to hold their money and not invest, then are we going to reduce innovation? So that seems maybe bad. They never talk about that. But anyway, they go on to say that because of this inflationary system we live in, everything is, artificially inflated in value because we're forced to not hold cash and forced to buy these other assets. He also points out, which I do agree with this point, which is that the real estate value of, let's say, an apartment in Tokyo or an apartment in New York City is way higher than it should be because, and the prices are insane because it's a wealth preservation move. It's not that it actually really has value. It's just that cash is just being diluted so consistently that you want to hold anything else besides cash. And so that's why you're holding these other asset classes, and people are buying, apartments on Park Avenue that nobody's living in just because they want to retain value. There's this theory that inflation is steering from the poor and enriching the wealthy. If you live paycheck to paycheck, you're pretty much only holding cash. And if you have other assets, inflation is driving the price of those other assets up. So all the rich people who own stocks and real estate, etc., are benefiting from inflation because the value of their assets is going up, while the poor people who just live paycheck to paycheck and hold cash are getting slowly diluted. So I think that's an interesting thing. But then if you go to a deflationary model, that means the people with a lot of wealth and currency or who are holding all cash are actually benefiting, while those in non-cash assets, like the rich people, I guess, today, will not benefit. And then Murad says, yes, I would describe this when, let's say, Bitcoin takes off and becomes the global reserve currency as the largest transfer of wealth event, arguably in human history. So what is the market cap of Bitcoin 10 or 20 years from now? And he goes, before I answer that, let's talk about 6 to 8 years from now. He believes that people, like, the trust in Bitcoin is slowly going to grow. In the year 2025, let's say, people are going to be like, wow, Bitcoin's now been around for 20 years. We've heard about it. The supply, there's only 21 million. It's only increasing 1% per year. The US dollar is increasing 6% per year. We'll be in this massive free market battle between gold, between fiat, between Bitcoin. And he thinks that Bitcoin will be in a black hole that will absorb a tremendous amount of value because of this fixed 21 million supply number. And when people start doing the math of how much they're being diluted with their normal paper currency, they would much rather own Bitcoin. He thinks that, or if he thinks that this occurs, a single Bitcoin will be worth $10 million in today's terms for one Bitcoin. That will be $160 trillion market cap or network value, a 2,000x increase between now and our death. He thinks there's a tremendous opportunity for an upside of Bitcoin here. So that's his opinion. Sounds crazy, but there you go. Tech-savvy individuals and eventually governments will push us to get to that extreme. So Pomp's like, okay, well, very few people in the world believe that. LOL, I like that. But he says, look, I'm confident that it will be bigger than the USD. It's like the gold standard in the late 19th century, but think about it, Bitcoin's a lot easier to move. Then Pomp talks about, a little bit more about the history of fiat currencies, how in 1971, we got off the gold standard. Every US dollar used to be backed by a certain amount of gold. Nixon got us off that. And now, we've seen this thing about for fiat, when they're not disciplined, when you don't have discipline of when you issue currency, you can lead to hyperinflation and destroy your own currency. So like in third world dictators, Zimbabwe, there's the infamous story of like the $1 trillion bill or whatever because of hyperinflation, because they pressed the button too much and they diluted too much. But in first world countries, people are much more reserved about their dilution, and therefore those currencies are retaining value much more, and they don't have hyperinflation, at least yet. Diving deeper into hyperinflation, how does this wealth transfer occur if Bitcoin takes over the world? And they basically say that, originally third world countries are going to be the first to suffer mass hyperinflation, and slowly the wealth, like an S-curve, will begin transferring into Bitcoin. And then there'll be sort of this FOMO moment where it accelerates and everybody goes into Bitcoin. It's called hyper-Bitcoinization, or that's the theory. I call it the Bitcoin FOMO apocalypse, but you pick. What they're saying is, when you believe in fiat currencies, there's a group of people who are behind the money and they can do whatever they want to keep printing money. Well, Bitcoin, there's an algorithm. And so you're sort of getting into this debate of, do we trust a machine or do we trust humans? Are we trusting humans who have proven time and time again that they are irrational, that they are undisciplined, that they can be greedy, and that they can usually ruin fiat currencies by overinflating them? Or do we trust an algorithm who is, by definition, disciplined and has a set of rules and is unemotional to be able to control our money supply? And that simple, trust swap from people to machines is what will win in the long term, because people will trust the Bitcoin algorithm more than a group of people running a central bank. Pomp begins to play devil's advocate, and he's like, okay, well, could Bitcoin go to zero? And basically, Murad's answer is like, look, the Lindy effect. Like, the longer, yes, it could. The longer something's around, though, the more likely it is to continue to exist. And that's the way a lot of technologies work. And so every day that Bitcoin continues to cement itself in the global, ecosystem, the more likely it is to continue to survive. If it were to fail, why? Basically because it's software. There could be a catastrophic bug, according to Murad, which is the most likely reason. There's 10 to 15 main contributors to or coders who are really behind this. They make mistakes. They're humans. And he thinks, he even references there was a recent bug in the code, and there will continue to be bugs, which is all part of, the evolution of this technology. But that is the biggest probably risk to Bitcoin. But he also says it's good that we're fixing the bugs now before this is a 10 or $20 trillion ecosystem with much of the global financial system running on it. What about too volatile? And this is something I argued with my professors in business school about, because they're like, look at a chart of the volatility of Bitcoin versus the volatility of the euro, the dollar. And I'm like, okay, easy. But for Bitcoin, and this is the same argument they make, from Bitcoin to go to from a dollar to Bitcoin to 10 million per Bitcoin, you need a lot of upwards volatility, because yeah, it needs to go up a lot relative to the US dollar, and that gets counted as volatility. And as Bitcoin stabilizes, gets bigger, gets more mature, gets more liquidity, the volatility will decrease. And this is not something that's unique to Bitcoin. This is a property that would be, that you would see in any sort of currency go from nothing to being a global powerhouse. So the volatility argument is very short-sighted, in my opinion. Bitcoin can't scale. And this is probably the most insightful piece of the entire interview for me, which is they talk about, people think about Bitcoin as a payment rail. They compare it to Visa, PayPal, and they're like, well, it costs so much more, like you can't do as many transactions. But he says, like, that's not a good analogy. Bitcoin is the settlement layer. It's the base layer. Visa and PayPal and Venmo are the third or fourth layer of our current financial system. Bitcoin is already developing second and third layer solutions, and those are the things that you'll compare to Visa and PayPal. Insert some hyperchange analysis here. Jack Dorsey, the CEO of Square, is invested in a company called Lightning Labs. I made a whole video about this, but there's this thing called the Lightning Network, which is a second layer solution on top of Bitcoin, which is going to be able to process a ton of transactions without running through the main chain, which is going to be what you're going to be using to buy a cup of coffee with in 5 or 10 years when you are paying on Square, which you already pay, which all my favorite coffee and bagel shops already use. Shout out to Black Seed. Anyway, so point being, this whole comparison of Bitcoin's settlement layer to the third layer of fiat is just you're missing the point here, because Bitcoin's very early, and they get more in this, and eventually, he says the Bitcoin base layer is going to be only for very, very big, large, secure transactions. It will actually get more expensive to transact on the Bitcoin blockchain, not for buying crisps or a cup of coffee. I like crisps. I just did that accent, but it's going to be a settlement layer where you need a lot more security, and security comes from fees. And so large businesses and commercial transactions will be settled on the first layer of the Bitcoin network, and then the trillions of transactions will be settled on the second, third, Lightning layer or side chains or things like that. And then he says Nick Carter, I don't know if it's the Backstreet Boys, Aaron Carter's brother, Nick Carter, but put it very well, saying layer one is not parcels, it's container ships. And so I love that analogy. If you compare it to gold, which, for example, gold is a means of final settlement among central banks every few years. Is that true? I don't know. Ask, you guys tell me. But I do think this is so true. How much does it cost to move gold from Europe to America? Absurd amount of money and time. And the price to settle a similar Bitcoin transaction of tens of billions of dollars, even with higher security, will be an order of magnitude cheaper and faster, even with that higher fee premium. So when you think about it like that, Bitcoin's settlement layer is actually a much more efficient settlement layer than the entire fiat system is built on. And then the second and third layers where the Lightning Network will be built, yes, you will sacrifice security for speed and availability when you buy your coffee, but that's just exactly like Visa and MasterCard work today. That, in short, is why Bitcoin is not competing against Venmo, PayPal, or Visa. It's competing against the Bank of International Settlements and the central banks for currency issuance. And that is where it has a competitive advantage, not in small value transactions. Everything that wants to be money has to go through an evolutionary process. It happened with gold, it happened with silver, it'll happen with Bitcoin. First, it needs to be a collectible, step one. Then a store of value, step two. Then step three, it needs to be a medium of exchange. And then four, a unit of account. And that's why he's not worried about it not being, having huge merchant adoption. He's like, the last thing that'll happen will be that you're buying a cup of coffee with Bitcoin. By then it'll be a several $trillion market cap, and it'll already be generated as a store of value. Right now, we're still in that collectible, moving towards a store of value phase. Every day it gets closer and closer to really fulfilling that store of value phase. And then it will continue along that path to being a currency that's a medium of exchange. And as it grows, volatility will decrease. It'll be easier for merchants to accept. The other interesting part, I'm actually not spending any of my Bitcoin and won't until it hits a $15 to $20 trillion network value or market cap, because the gains in percentage terms are just too much. I can make 100x from here, but then once it's at 15 or 20 trillion, the gains from holding Bitcoin will only be 5 or 6x. So I'll be, the incentives will be different, and I'll be more willing to spend it. And he goes, remember the pizza story when some guy spent 40,000 Bitcoins to buy 2 pizzas? That could have been hundreds of millions of dollars, and now nobody wants to be the pizza guy. Love that. So eventually, Bitcoin will be a medium of exchange, but right now it needs to be a store of value. Pomp brings up a great point here. Devil's advocate, you could argue that the code could be changed, or a hard fork like Bitcoin Cash, and then we have a different supply schedule. Essentially, what are the ways the 21 million number could change? Is that really, a thing? So honestly, not super convinced with all the answers here, but he says, look, if there's a fork with the Bitcoin Cash scenario, then the analogy he makes is just because Zimbabwe is printing a ton of its dollars doesn't hurt the US dollar. So I like that. But the part I'm not convinced is what if the Bitcoin consensus decides to make it more than 21 million available? I think the 21 million number could change. I don't know. I'd love for you guys to comment that. But his counterpoint is that the miners aren't controlling in Bitcoin. The users are. For example, in the Bitcoin Cash fork, 93% of miners wanted to increase the block size. 85% of exchanges and wallets were on their side. Many of the wealthiest Bitcoiners were on their side, but they couldn't make the change without the consensus of the people. And so they didn't. And that's why they forked into Bitcoin Cash. So I'm a little out of my depth there, but that's his explanation. They talk about the creator of Bitcoin, Satoshi Nakamoto, Bitcoin's anonymous founder. Is it a girl? Is it a guy? Is it a they? Is it Is it an alien? Is it a group of people? We don't know. So he says, is this good or bad for Bitcoin? Basically, they're look, it doesn't matter. Bitcoin is what it is. The technology's there. The anonymous factor is kind of cool, but at the end of the day, it's not going to matter if we know who Satoshi is or not. Then they go to this thing of the musical chairs theory, which I love. Right now the music's playing, everybody's walking around, but at some point people are going to have to sit down, which is like, and basically what they're saying here is like the FOMO theory of like when big money starts to want to get into Bitcoin, it'll be a self-fulfilling prophecy. And they point out Swenson, one of the leading investors of all time. He runs the Yale Endowment. He is a trendsetter for all institutional asset allocation, recently put bets on 2 crypto funds, basically opening the tide for institutions to start getting into the space. And although he didn't buy Bitcoin specifically, he invested in funds that will invest in a lot of things like Bitcoin and Ethereum and also in ICOs. But this is starting the tidal wave of the musical chairs and sort of the FOMO theory of institutions getting into Bitcoin. And, you know, they make the point that Bitcoin is such a drop in the financial system, even though it's like 100 billion plus compared to what it could be, or compared to how big the financial system is with trillions of dollars of assets, it's still, you know, nothing. We still really haven't seen the institutionalization of Bitcoin. And if it does, the float's so small that the price will run up dramatically. So now Pomp goes, so if you're a central bank, what would you do? And he says, I would basically invest in Bitcoin directly. And then he also makes an interesting point about crypto funds, which is like, he thinks that Bitcoin is going to crush all other crypto assets in the long term. But if you're running a crypto fund, you can't just buy Bitcoin, because then why would anybody invest in your crypto fund? They just buy Bitcoin. So thought that was funny. And this is why, you know, Murad's a Bitcoin maximalist. I don't know if he's right or wrong. It's just his theory that he says a lot of people think there'll be 6 or 7 cryptocurrencies that kind of battle it out, but he thinks there'll just be one, and that'll be Bitcoin. And honestly, like, I kind of agree with him. I don't know if it'll be Bitcoin or not, but I just think like logically and rationally and financially, it just makes way more sense to me that like if we're going to do this global currency that is like available everywhere, like for all the advantages to be there, like it's going to be a huge network effect thing, and it'll be one global reserve currency, and like that's just simpler for international trade. It'll gather more trust. Like it just seems like that's the way it'll play out. So I do think the theory that like it's kind of a winner take all for this cryptocurrency market is true. And then Pomp sort of goes on this rant that like, if you're not holding crypto as an institution, then you're breaking your fiduciary duty, because it's been the best performing asset class of 10 years. And I think crypto, it's also important to note that Pomp's entire job, I think, is like trying to get institutions to invest in Bitcoin and stuff. So I think he's biased and kind of pitching it there. But yeah, he's on this whole like mission to like get institutions to not have zero exposure to crypto, which I actually think, yeah, I think that's very smart. And like, honestly, like, that's what I do with my personal portfolio. Like, I want a little bit of exposure to crypto, because I think I don't necessarily 100% believe in everything they're saying here. It's kind of like a crazy podcast, but like, I do think there's a good chance. And I think a lot of the arguments they make about an alternative to the inflationary based monetary system is valid. Inflationary monetary system has worked, but to say that it will never change, to say that that's the only way forward, and not think about different ways that money can work and what money is, and not be open-minded to that, and not at least have exposure to the most disruptive thing we've seen in currency in probably over 100 years, that's already shown that it can work and be around for a decade and amass $100 billion, aka Bitcoin. Like, to not think that that's already proving, like, you can't say Bitcoin's bullshit and not working, because it literally is being used all around the world by tens of thousands, maybe millions of people who have wallets and who own it, and that has hundreds of billions in network value. So it is working in a way already. So I think it's just really important to note that like that's my biggest takeaway from this, and what I hope all the hyperchangers take away. No matter what you believe and which school of thought you're a part of, just keep an open mind and realize that the way we transact value and the way we store value as a society, as humans over civilization, has always changed. The one thing that's constant, the one thing that's guaranteed, is that the way that money always changes, and that what money looks like and is always changes. And so at a high level, like, I just think this system based on paper and fiat is a lot more archaic and old school than a system based on software and algorithms that seems developed in the internet world, which we're now living in. So that's why I've always been very biased to Bitcoin. And that's why I bought Bitcoin years ago when I was in college, because I thought like, wow, like internet money, why do when I go to Italy, I have to like change money. There's a huge fee. It's super inefficient. Like, just money that's native to the internet just seems so obviously the future. And so that's why I've always thought Bitcoin's fascinating. But back to the podcast. Oh, I also wanted to bring up this article that I wrote in 2014 about why why Apple should open a Bitcoin bank. And so I had this theory that when Bitcoin was only worth like 20 or 30 billion, Apple could spend, or like 10 or 20 billion, Apple could spend $1 billion or $2 billion of its $150 billion in cash to start quietly buying Bitcoin in the open market, get like 10 or 20% of the overall Bitcoin, and then launch their own banking platform built on Bitcoin. And because they own so much Bitcoin, they could actually be the equivalent to the Fed of Bitcoin, buying it back and selling it to stabilize it or destabilize it or whatever they wanted. And so I just think this is and it's kind of like a weird, crazy theory that I wrote about, but I think you should all check it out, because this is what essentially they're talking about here, is that if they were a central bank, or if you were a major asset allocator, what would you do to get into this space? And you would have to like super stealthily start buying Bitcoin and just do it quietly. And that's what the next part of the thing is. They say, like Pomp's like, well, what if a central bank tried to buy 5 to 10% of Bitcoin? And he's like, look, it would start skyrocketing, because even though there is 15 million or 20 million or 15 million Bitcoin out there, he thinks 10 million are being hodled. People are holding it. They don't want to spend because there's so much upside. So the real float of Bitcoin is like 3 to 4 million. And the second you start buying it in big amounts, the price is going to skyrocket. And every incremental 0.5 percentage point of Bitcoin you want to buy will cost you, multiples more than the previous half fraction. And it'll sort of be like this, float lock concept, which is something we can get into later. But this is where it's so interesting, because this is where Murad gives a very real opinion that I agree with, and that it kind of freaks you out. It's like, basically like, look, like the people are going to win with this, and he thinks actually Bitcoin will make the world more unequal. And I don't think, and like increase the wealth gap. And I agree. And I don't know if that's good or bad, or probably bad, but like, it's just the reality of the free market situation, that the people with the most money, the ultra high net worth individuals, savvy fund managers, are going to be the first people to really start buying Bitcoin. That's already what's happening. The people who are smartest about technology, people who have the most capital to throw around, are the people who are the earliest here. They're people who are going to get the wealthiest. And so ironically, this is one of my favorite parts of the whole podcast. The people fighting Bitcoin ideologically will be helping it the most financially, because then you start this FOMO theory of like, well, shit, if Bitcoin's going to be the future and I'm already rich and I want to stay rich, then I better start buying Bitcoin, and that's going to drive the price of Bitcoin up, and that's going to further and turn it into the self-fulfilling prophecy, the Bitcoin FOMO apocalypse. Anyway, then Pomp asks him to give a 60-second pitch if a central bank or government leader is listening, on Bitcoin. And he goes, it's the soundest, hardest currency that has ever been invented. Its disinflation principles are second to none. Its monetary policy is years in advance of anything else. It's increasingly credible. It's increasingly a threat to the currencies you control. It's getting in before most other sovereign wealth funds will prove to be one of the smartest investment decisions in the course of human history. Countries that stealthily will acquire Bitcoin will thrive, while those that don't will suffer tremendously. Does the opportunity in Bitcoin still exist? And then Murad's, I love this answer. He's like, actually, I think on a risk reward basis, the opportunity in Bitcoin could be better than ever, because a lot of the problems have been worked out. Its brand is bigger than ever. It's been validated for more than a decade. In many ways, it's less risky to invest in Bitcoin now than ever. More smarter people are building on it. More companies are building on it. And you still have the 100x upside, maybe even 1,000x upside, if you believe in that $80 trillion to $160 trillion end game for Bitcoin. That sums up the podcast, and man, it was a long one. It sort of freaked me out, because I don't know, in some ways I find a lot of comfort in being a finance nerd in the way the financial system works. And I think this is the biggest thing you got to take away from this and about Bitcoin, is like, just because you're comfortable with like, oh, the stock market's compounding at 7%, the US dollar is the most leading currency, and like all this stuff, and everything just seems so natural, and you think how the financial system works, and you get comfort in that because that makes you feel confident in your future. Then when you think outside the box, and you're like, wow, what if every fiat currency does crumble to something like Bitcoin? What is that going to mean? What if we do live in a disinflationary economy instead of an inflationary economy? These are really, really big questions that not enough people are taking the time to think about. And to be fair though, I don't know if I believe this at all. Like, I think part of these guys this is like the most extreme Bitcoin argument you'll ever hear in a lot of ways, but does it make sense on a lot of levels? Yes. And so I think I don't know. Anyway, I'd love to know what you think about Bitcoin, about this podcast. I'm going to put a link to it. You should totally listen to it. I listened to it twice. It'll make you think outside the box. Go into it with an open mind. Huge shout out to Pomp for doing this podcast, and Murad. This was unbelievable content, amazing stuff. I'm hoping that I can interview Pomp for Hyperchange as well. I think that would be an awesome episode. So Pomp, if you're watching, maybe we can make that happen. Anyway, please leave comments below. I bet we can get epic discussion going. Also, huge shout out to the Hyperchange Patreon producers and Patreon supporters. It means so much that you are supporting the channel. We have a ton of like epic content in the way. So just stay tuned. Anyway, I'll see you guys next time. Peace.